Now let us go to the next important provision. What is misreporting of income? There are 6 situations in which the income would be regarded as underreported income would be regarded as misreported income. Section 270A, subsection 8 lays down that if the underreporting is in consequence of misreporting, the exceptions mentioned in subsection 6 will not apply. We will see in the next slide that all these 6 situations which are laid down in subsection 9, they indicate that the additions are in respect of those incomes which were in respect of which there was misrepresentation of facts or there was suppression of facts. So they cannot be covered by exceptions. We have seen 5 exceptions under subsection 6. They pertain to those cases where income is estimated or where all books are maintained, but the method employed is such that some estimate is required. But where there is willful suppression of facts, subsection 6 will not apply. And even the penalty will be levied at 200% of the tax payable on the underreported income in consequence of misreporting. Now let us see these 6 situations of misreporting. Number of issues are relevant in respect of these 6 situations. Look at this. The first situation is where underreported income represents misrepresentation of facts or suppression of facts, where the SSC did not disclose certain income. The SSC suppressed certain facts and they were not manifest on the books of account, on the statement of accounts filed, in the computation of income. Then the underreported income, the addition made, will be regarded as underreporting in consequence of misreporting of income. And misrepresentation of facts could be anything, like a clear purchase of capital asset debited to profit and loss account. Plant and machinery is purchased. Bill is so clear, but it is debited to profit and loss account with the object of misguiding. It is claimed as deduction. This is misrepresentation of facts. Second situation is failure to record investments in books of account. In these days of AIS and TIS, one cannot afford to miss recording of investments in books. Because if you invest, the information reaches because of artificial intelligence to the income tax department. But if an SSC has, in spite of all this, failed to record investment in books of account and the source cannot be explained, it will be regarded as unexplained investment. Now here, apparently and very clearly, there is an overlap. Section 270A in subsection 9 says that failure to record investment in books of account will be regarded as misreporting of income. But we are aware of sections 68, 69, 69A, 69B, 69C, 69D, where under section 69A, unexplained investments are covered, where investments are not recorded in books of account and they are discovered. They would amount to unexplained investment, and particularly where the SS is not able to establish source. If it is regarded as unexplained investment, please look at the relevant section. Tax is leviable under section 115 BE, 115 capital B capital BE at the rate of 60%. As per Finance Act 2023, surcharge is leviable at the rate of 25% on tax. So on 60% tax, surcharge is leviable at the rate of 25%, which comes to 15%. So 60 plus 15, the tax payable will be 75%. And then we have a separate penalty provision under section 271 AAC, where penalty in respect of unexplained investment is to be levied at the rate of 10% of tax on such income. So tax is 60%, 10% of it is 6%. Now in this case, take total of all this. On unexplained investment, if the amount is 10 lakhs, tax will be at 60%, 6 lakhs. 25% of this will be surcharge. So 1 lakh 50,000 will be surcharge. And 6% will be, 10% will be penalty. So 60,000 rupees will be penalty. Whereas if this is not regarded as unexplained investment, tax would be leviable at 30%, plus education and higher education cess and surcharge. Penalty at 200%, so 60%. So 30 plus 60, 90% plus surcharge. The total amount payable would be in the range of 92%. Whereas if it is regarded as unexplained investment, it will be 81%, 60 plus 15 plus 6. So the amount payable will be lesser. Now one would wonder whether section 270A will prevail or section 271 AAC will prevail. If you read section 271 AAC, it has got non-obstante clause. It starts with notwithstanding anything contained in any other provision of the Act, this provision will apply. So 271 AAC will prevail over 278. This is an unintended overlap which has not come to the notice of the government. Otherwise, there is no sense in including this here, at the same time including this in separate provisions 68, 69, 69 A, B, C, D. Levying tax under 115 BB, levying separate rate of surcharge, levying separate penalty. The next situation is also similar. Claim of expenditure not substantiated by any evidence. So if you claim an expenditure, you are not able to substantiate by evidence, the expenditure will be regarded as unexplained expenditure, covered by section 69C. Here also, same provisions apply. Under section 115 BBE, tax is at 60%, surcharge at 25%, penalty under 271 AAC at 10%. So again, same overlap is here also. The next situation, recording of any false entry in the books of account, leading to addition of income. Now take an example here where some taxpayers record false entry for purchase and sale to show higher turnover to bank for the purpose of obtaining loan. So if the purchase and sales are recorded at same amount, both are false entries. But then this does not lead to any addition in the income. If there is no addition in the income, there is no misreporting. But if sales is recorded at 100, purchase is recorded at 80, both the entries are false. There is addition of 20 rupees on account of false entry. And if the entries are false, this 20 rupees will be regarded as misreporting of income if it is not offered for tax. Next situation is failure to record any receipt in books of account having a bearing on total income. So again, if any receipt is not recorded in books of account and that receipt is in the nature of income, it will be regarded as misreporting of income. But if some loan was obtained and it was skipped from recording in books of account, SSC is able to establish that this is a genuine loan. There is no impact on income. And in such a situation, there will be no misreporting of income. And the last situation is failure to report any international transaction or any transaction deemed to be an international transaction or any specified domestic transaction to which provisions of Chapter 10 apply. So here also the issue is very clear that if there is a failure to report an international transaction, if it was reported, its arm's length price is higher than the transaction recorded in books of account. And this leads to addition in the income. It will certainly be regarded as misreporting. In the same manner, if any specified domestic transaction was not reported, and if it is reported, it would lead to addition in the income. Certainly, addition made by the officer will be regarded as misreporting of income. But if any international transaction or any specified domestic transaction is not reported, but even if reported, there is no addition to the income because the transaction was done at arm's length price. In that case, there will be no misreporting of income. It is a different matter that under separate penalty provisions for not reporting international transaction or for not reporting specified domestic transaction, penalty would be leviable. But if there is no addition to the income, as this international or specified domestic transaction was already at arm's length price, in that case, if there is no addition, there is no misreporting of income. But if there is addition, it will certainly be regarded as misreporting of income. So these are, friends, the provisions relating to penalty under Section 270A.